Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, Kilroy Architectural Windows, Inc., New York's Window Company, New York Community Bank, Capital One Bank, Greenberg Traurig, LLP. Additional funding is provided by grants from Akron Gold Brothers, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, Friedman, LLP, Gemini Real Estate Advisors, LLC, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackel Realty Services, Meridian Capital Group, M&T Bank, Muss Development, LLC, Des Moines Group, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling, Stonehenge Partners, Urban American, W Financial Mortgage Fund, the Witkoff Group.
Hello, my name is Michael Stoller. So we're in 2010. Are we better or are we worse in the state of the real estate market, the economy? Where are we? So to get a better feeling of where we are, I've brought together some real estate, some business people, and even an economist, we're not sure what he does, to really provide some insight on the state of the world, and the real estate and the business world. My guests today are Philip Eisenberg, the chairman and CEO of Urban American, Dr. Sam Chandon, my good friend, the executive vice president and global chief economist for real estate, Real Capital Analytics, Ron Greenspan, Senior Managing Director at FTI Consulting. And last but never least, my good friend David Sterling, the Chairman and CEO of Sterling & Sterling. David, you're a global insurance brokerage firm, and you have lots of clients who are in the real estate business. How do you see the market today?
It's a strange market, Michael. People are getting along. A lot of the real estate guys are able to carry their debt. They're getting lower rents, both in residential and in commercial. And some guys are losing some buildings because the refinancings are coming up. But it's a stalled market. There's no deals to do. They're getting frustrated that people have cash, and the people who want to refinance are frustrated because they can't.
I mean, that's such an appropriate comment to hit Ron. Ron's here from California. He handles the national practice for restructuring in real estate. Now, I want to address Ron, but I also want to say Philip's been around long enough that he's seen restructurings, and I'm going to ask Philip in a second. So how do you see it? We were talking before the show that we're like stuck. Nothing's happening, low interest rates, nothing. So where do you see this?
I mean, we are in a situation of a big bid-ask gap. We have the buyers with the cash, but we have the sellers who frankly aren't motivated to do anything. There are no voluntary sellers out there today. Nobody believes this is an opportune time to be liquidating major assets. And at the same time, there's no pressure upon them absent an event being a loan coming due with the inability to get a forbearance or inability to come up with the cash necessary in order to refi at lower advance rates today, or some other event that actually forces them to the market and takes a price they're not happy with.
But aren't we, in 2010, the largest transaction ever was Stuyvesant Town. It's in foreclosure. What are they going to do? Somebody has to do something. Well, the special servicer has to make a decision. Lucky, Philip and his investment group could have bought it, but he's bought other assets and he realized it was too expensive. What's going to happen?
without talking about that project
No,
in particular.
I'm talking
on
in general
major,
about other transactions of buildings, of apartment buildings, of office buildings, where the debt has come due, or where the landlord, the owner says, here, take the keys.
and that is a situation where you're seeing, although owners are offering keys, for example, Stuyvesant is an unusual situation where it's actually going back to the lenders. We're seeing, quite frankly, as was described, really stalling, what we've been affectionately called amend and pretend, amend and extend. Nothing forcing a transaction to occur. But when the assets are coming back to the servicers, are coming back to the lenders, they're not sitting on them. They're trying not to fire sale them, but they are disposing of them generally in a relatively orderly process. The issue is not what's coming back because they're not forcing them back.
Philip, let's go back to the 90s. You were a bank attorney, you've been involved with this. What's different now as opposed to 1991 RTC days when you had properties, when you were representing Citibank and so on? Where do you see?
Well, in those days you had the FDIC and FSLIC, and they were really out there enforcing the capital requirements of these banks. They would come in and say, look, you're underwater, you have so much time to get out and get out and get capital and get back in compliance. And there'd be one chance, two chances, and then one Friday afternoon, they would show up at the bank, close the doors, take away all the officers' leased cars, drive them home in a van, and the bank was closed. And the next day, they'd start liquidating it. They'd pass it on to the liquidators, who would then pass it on to another group. And eventually, there was this process by which the RTC was created, and they all then end up in the RTC. Now, in some of these banks, 16% of the loans were bad. The rest were good. And they were with the same developers. And these guys had histories of years and years and years with these borrowers. And they thought, well, we would stick with them. We'll work ourselves out. It won't be too big a hit. But then there was no stick with them. It's all done. You're out. We take all these assets. We've got to liquidate them. And they used to liquidate them at outrageously low numbers because they didn't know what to do.
Prior to the show, you said that you bought a loan, that you weren't in default, at 50 cents on the dollar,
right,
because they just wanted to sell it.
The bank was liquidated. Well, it took more than that. The bank was liquidated. The bank was liquidated. It went into the LIC, then went to the RTC, and I had a provision in the loan agreement that said when I get a new tenant, I can draw so much for TI, depending on what the price of the lease was. Well, so I write them the letter, and they send back, well, you know, the RTC has the powers of a receiver. And we decided to abrogate that clause. So I said, well, guess what clause I abrogate? The one that says I pay interest and taxes. So I would put the interest and taxes in a secure account in escrow. It took me 9 months before I could get somebody on the phone. And the way we got them on the phone was the building happened to be in Chattanooga. And my brother-in-law's friend was the tax collector. So we had to get their attention by accelerating the foreclosure so they would come up with a check. Then after they had to write the check, then they called me up and said, what would you like to do with this loan? I said, well, you're going to put it out there for 10 cents. I'll give you 50 cents. And they thought it was a bargain.
Now, here's the situation. Aren't we having similar situations dealing with certain of the banks or the special services to get a response? You know, people, you know, if the loan isn't in really, you know, in over 90 days, the special service is only getting paid a certain dollar amount. They make more money when the loan is in a troubled category. How easy is it to speak to the special servicer?
Well, even
with the exception of your FTI.
Yeah, even before that is under the. What's different is back in the RTC, S&L days, or even the banking transactions 10 years ago, the loans were made and held in the institution. And while it may have been difficult to get somebody on the phone, at least when you reached them, they had authority. It was that institution or a loan group that could modify that loan. Today, with these loans and the securitizations, there's a relatively strict contract that says when these loans can be modified and how they can be modified, which if you're an investor in a securitization, you put your money up, there's a trustee running it, you want that type of assurance. I mean, there needs to be a regime that you can count upon. But that type of regime, when faced with economic changes and value drops like nobody ever anticipated, becomes very, very sticky and prevents much of what could be done. Well, in the servicing situation, the loan is initially serviced by a master servicer. The contract, the securitization documents, the pooling and servicing agreement says the master servicer is forbidden from modifying that loan. So the first thing you have to do is you have to get it into special servicing. And that's where we're seeing a bunch of intentional defaults, not too different than what you did 20 years ago in order to get the loan transferred from master to special. And then, as you said, the special servicer has different incentives depending upon where it is in the stage.
But it takes time. So, Sam, you're with you go down to the Washington. You're with the FDIC, meeting with them. What's happening today?
I think there are a couple of different things. On the CMBS side, certainly, I think part of what makes that system attractive is that there is predictability. There's a very well-defined set of rules that will preclude changes being made early in the process. When we look at the individual banks, I think over the course of the last year, we've had a pretty significant shakeout amongst the largest institutions. And now the FDIC and other regulators are turning their attention to the regional and community banks that individually and collectively constitute a larger pool of commercial mortgages than even we find in CMBS. Right now, part of what is slowing the system is specific choices that are being made by the FDIC and other institutions. They're not concerned specifically with regard to outcomes in commercial real estate markets. They're not concerned about supporting an improvement in transaction activity. Rather, they're concerned about the potential for a deterioration in the commercial mortgage pools or an acceleration of that resolution to impact the ability of these smaller banks to lend credit in other areas of the economy. As a problem they've come up against now is that slowing down the process of resolution in commercial real estate pools doesn't in itself lead to an improvement in credit outcomes for small businesses, for families, and they're having to contend with that now.
Values are down. We would all agree values are down. So how do you create we're in inertia over here. How are we gonna move the ball up the stream?
Well, I think it depends on who you're talking to. I think anyone who wants to invest and who's waiting on the sidelines, or anyone who makes their money by facilitating investment activity is finding the process excruciating and is incredibly frustrated. But if you talk to folks who are on the side of ensuring that we don't have a large number of fire sales, that we find reasonable solutions with borrowers who are operating the assets now, they're extraordinarily busy.
David, I'd like you to say something, but we were saying before, you have clients, friends, investors all sitting on the sideline looking to do things.
Yeah, well, if you want to have growth, you're going to have a market. We don't have a market right now, and so I remember when I was in high school, and we had the price and wage controls, and I remember reading about, not understanding it then, but now I really understand it. You can see these kind of forces at work. Reading about how the wage and price controls had almost the opposite impact, because you can put pressure on them, but then a black market economy, you'll have unintended consequences from it. So here, the slowing down that you're talking about, that is purposely being done to protect the credit markets, is actually having a negative impact on appreciation and growth, which, if not watched, can also have just as dastardly an impact.
No, I think I have to agree that these interventions into the private market have had many unintended consequences, and not only in commercial real estate, but in other aspects of the economy, we're not observing the kinds of outcomes that we'd like to be observing. And ultimately, the private markets have to take over the role of price discovery, of supporting transaction activity. In the absence of that private market activity, we're not going to be able to move forward in our sector or in the broader economy.
No. An interesting thing, Philip has a fund. He has investors who are pension funds from around the country. They are looking for return. What are they saying to you today?
The last visit from one of the large investors says, so you bought in 2007 and you bought in 2008 in the highest market, and you're flat. Congratulations. Move on. Let's go to lunch. That's their expectation. They're just looking to preserve principle, and each year we have to have appraisals, and the NAV in a particular portfolio, if it's moved a bit down, because while you've increased your NOI, which we've done in almost every portfolio we have, cap rates have changed, and so your value can go down despite your NOI being up. But they know that our business plan is a long-term business plan. We just have to continue to improve the properties.
Because your type of, you have a single type of asset. You have multifamily residential apartments. It's not, people have to live in a place.
That's right.
Okay, it's workforce housing where
Right.
people have to live there. It's a different type of asset as opposed to offices, or as we said before, zombie offices where they can't, they expected $100 a square foot and they can't do it. I mean, Los Angeles had it, New Jersey had it, Texas has it. I mean, wherever this is going to be there. We were discussing what the government has done, with low interest rates. It's a good and it's a bad. You were saying, like Japan. Look what happened in Japan all those years.
What scares me is, yes, you're flat. We've seen some major price declines elsewhere, but that's happening in a historically low interest rate environment. That as interest rates go up, I'd be curious to hear everybody else's take on it, but clearly the federal efforts to maintain low interest rates may last for a while, but they can't keep that genie in the bottle. And when rates return to a fair market equilibrium level, is that really going to take another major leg down in real estate values? To me, that's the scary part. And unless we have some type of capital allocation.
Our position is that we don't have to refinance anything until after 2013. So I've got a little breathing room.
So you have 3 years. What happens in 2013?
And we'll maintain a certain amount of cash. And what's going to happen when we refinance, which we discussed before, is that if my NOI goes up, congratulations, we're not going to give you as much money as before because we're only going to lend 50%. So we may have to have some cash that we keep around to refinance that way, or maybe it's called subfinance. But that's what's going to change unless things change a lot in 2 years.
And the spreads are huge now. The banks are getting money for free, but they're not lending it out for free. And so, from a real estate perspective, if people are borrowing money at 5 or 6, and it's costing the banks a lot less than that, so when it starts costing the banks 2 and 3 and 4. It may not be that dramatic an impact because they've got these large spreads. So it'll shrink their spreads and maybe their windfall profits won't be as big.
Yeah, I think one of the challenges there is, as you suggested, there's this likelihood that rates have nowhere to go but up. And particularly if we observe inflationary pressures in the economy, it's almost a given that short-term rates will rise, and ultimately that'll lead to a rise in long-term rates as well, even if we have fairly modest expectations for how the economy will grow. There's the potential for an offset in that these spreads could narrow. Part of the challenge for us, though, is that when you look at the weakening of the property fundamentals across the board, no matter what sector you're talking about, we've got the potential for rising defaults in commercial real estate over a number of years. And that may make it very difficult for those spreads to narrow because the perception of the nature of the underlying risk in taking an exposure in commercial real estate could worsen as we observe a larger number of defaults and a larger number of losses.
We saw CMBS spreads get down to 80 to 110 basis points. Exactly.
Right.
Well, that's double A, single A, double A area, and you will never have that type of liquidity. And the reality is you don't have that type of stability and risk profile with real estate.
Ron, I did a show a couple weeks ago, and I had somebody who was out of the CMBS market, and for my viewers who don't understand, because we don't like doing inside baseball, collateralized mortgage-backed securities. And I said, you were at the Bear, now you're back in the conduit business, and you're going to be doing CMBS, and now you be conservative. And what happens in 3 years when you become a bad boy again? When, as you said, the spreads go down to 80 basis points. People just continue. But Japan, I think, is a great example. Look what happened in Japan. Look what's happening in Greece. Look what's happening even in London. The markets over there were even worse. We haven't seen, we look at it in a myopic point of view in certain, this asset, that asset. But when some of these buildings cannot pay off their debt, the example that I gave to all of you before, especially that I mentioned to Philip yesterday at lunch, was 1515 Broadway, and I think it's a great example of the world. It was a $625 million mortgage, which they only got $475, so somebody had to come up with $150 million. and not everybody has $150 million in a deep pocket. So what happens to these hospitality, the extended stay, Harrah's, all of these hotels which were over-leveraged? What happens to office buildings that people paid $1,300 a square foot that probably may be worth $300 today? What happens?
Well, it's only one of two things in the long run.
I'm just,
You're either
I'm just the moderator. I'm a little
price is either going to reflate, or we're going to go through a deleveraging process through ultimately foreclosures, ultimately forced sales, where you will ultimately have market price discovery. But that's it. The difficulty we have, especially with the intervention that's going on, and look, nobody really believes we're going to have the reinflation. We're going to have the deleveraging and ultimately transactions reoccurring. But with all of these steps out there that are really forestalling this and slowing it down, it's going to be a very extended period of time. I mean, we're going to be in this agony for 4 or 5 years.
And that's my question. How long is this agony going to be there? David, you have clients, you have funds that you represent. I hate to say funds in many cases, except for Philip, they're like deal junkies. A deal junkie has to do another deal. They can't sit here just doing nothing.
Yeah, but there's niche deals out there, and I think that the stuff that we're talking about, the office buildings, some of the residential stuff, you just can't touch it because it's stalled. But people are starting to find little niches where they'll find a deal. Some people will start scooping up very small deals and package them. Other people will go outside of the big city, New York and Los Angeles areas, to find buildings that they can buy.
I can go to New Jersey. I can pay $47 a foot
less.
In Fort Lee. Yeah.
I have a client who bought a 100,000 square foot warehouse in South Jersey for $1 a foot on 20 acres. And so, and the taxes were $2.50 a foot.
I had a fund on the show a couple of months ago who hadn't invested in 2 years, and he said, I just bought a 1 million square foot shopping center in Houston, Texas, and I paid $15 a square foot. I mean, can't build it for that price, Sam. I mean, Economist, you're the man with this analytical.
There are constituencies in the market that want this process to take a very long time. And part of the thinking behind that is that over the course of 2 or 3 or 4 years, we might see an improvement in the underlying fundamentals that will support not a very large process of deleveraging, but maybe a slightly smaller one. And that will blunt some of the downside risks. Which brings us back, you talked about looking at the microcosm versus the bigger picture. I think that really brings us back to this question of, okay, the government has been very involved in supporting economic activity. It's not clear what level of private activity has its own momentum as the government begins to withdraw. 2 years or 3 years down the road, in 2013, when you have to refinance, how many of the jobs that we've lost will we have actually replaced? I think it'll be a lot easier for banks and other lenders to work with the borrower who has a high occupancy rate, who has real momentum and rent growth. But there's a real question about there. We don't know what kind of recovery we're going to have at this point, and it could very well be a weak one.
So how long does the recovery take? Is it 3 years? Is it 5 years? Philip? Sam?
Sam mentioned something very important. This is about jobs. And the unemployment figures don't show, that we see, don't show everything. We notice what I call shadow unemployment. As we have working class people, and some of them work at 2 jobs to make things go, to pay for school, for this or that, and they've lost their second job. And so they're squeezed. So rents come in a little later, but they fight to get it done, but there are a lot of things that they don't do now that they did before. And that is, that's having an effect on the economy. Or we look at an apartment, it's the same number looks like the same number of people. Nobody's moved in that we know of, but the water bill's going up. So these things are happening, and it's pressure. And as I mentioned before, the other side of it is that our contractors, our suppliers, our vendors have had to lay people off. And so your response isn't quite as good as it used to be in some areas, and you have to pay them currently because you'll break them, because they have no room to move. And that part of the economy is really all about jobs.
Right, and I think at this point, when we look at some of the programs that the government has introduced in an attempt to spur job growth, it's fairly clear that we don't have a comprehensive or broad-thinking solution. We can talk about green jobs, we can talk about jobs in specific sectors, but none of the jobs that we're talking about creating in these programs offer the magnitude of impact that we need to replace 7 or 8 million that have been lost, let alone in our sectors, meaningful job growth on top of and replacing the jobs that we've lost to get new net absorption.
You know, we failed to bring up that in the last 2 years, there's no new construction in New York. Look at all the jobs that really are lost in that hasn't even been taken into consideration. Because once these construction jobs of the apartment houses on the west side, the apartment houses in Williamsburg, you can have unemployed contractors. You can have unemployed trade people.
Well, one of the things I'd suggest here is that we're actually, when you look at the data, in a better position in New York than we are in many other of the major metropolitan areas in the country. And we're certainly in a better position in New York than where many people had thought we'd be in late 2008. The Independent Budget Office released their newest assessment of total job losses in the city, financial services and other sectors, and it's a much smaller number than the numbers that they were talking about late in 2008. Financial services, we talk about, they're not lending, but certainly the largest money center banks are quite profitable. And
because they're not doing anything.
But going to your construction,
we unfortunately, 30 minutes have gone by, but I think this conversation, which I know we will bring back all of my guests again to bring this up in a couple of months. But I'd like to thank Philip Eisenberg, Dr. Sam Chandon, Ron Greenspan, and David Sterling. See you next week.
Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, Kilroy Architectural Windows, Inc., New York's Window Company, New York Community Bank, Capital One Bank, Greenberg Traurig, LLP. Additional funding is provided by grants from Akron Gold Brothers, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, Friedman, LLP, Gemini Real Estate Advisors, LLC, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackel Realty Services, Meridian Capital Group, M&T Bank, Muss Development, LLC, Des Moines Group, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling, Stonehenge Partners, Urban American, W Financial Mortgage Fund, the Wickoff Group.